Ever since President Donald Trump started talking about tariffs and implementing tariffs, the stock market has been volatile, experiencing significant swings, and some stocks are down significantly from their highs and in 2025 in particular. SoFi is one of those stocks. It's down almost 25% year to date in 2025. And given the broader stock market volatility and the declines on SoFi stock, it's a good time to conduct a risk analysis for SoFi stock investors to understand some of the risks the company is facing and to determine if we want to accept those risks and invest in SoFi stock for the long-term benefits that comes with that investment. So that's what I'll do in this video. I'll look at three big risks SoFi is facing, both for the near term and the longer term. And then I'll share with you my proprietary discounted cash flow model for SoFi to share with you what I think a fair value is for this business today. And then I'll close by giving you what I think the stock deserves in terms of a buy, hold, or sell rating, given all of the current circumstances SoFi Technology is facing.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I highlighted in the introduction of the video that SoFi stock is down almost 25% year to date in 2025, but it didn't start out that way. In the beginning of the year, SoFi stock jumped up over 15% as investors were enthusiastic of the company's prospects in a growing economy with low unemployment and inflation coming under control. But all of that has unraveled as the year progressed. Now, the broader macroeconomic picture doesn't look so strong, given the increasing tariffs and how that impacts consumer behavior. The outlook for the rest of 2025 is not as strong as it was just a few weeks ago. Now, the risks of recession are higher than they were just a few weeks ago. That means more unemployment. And let's look at why that's not good news for SoFi stock. So one of the reasons why this increasing macroeconomic uncertainty is impacting SoFi stock significantly is because SoFi has a high-risk loan portfolio. There are loan portfolios and then there are loan portfolios. SoFi's loan portfolio is on the riskier spectrum. Now, I know you've probably heard about SoFi stock and SoFi management only lending to high credit score borrowers that have a high income to sort of reduce the risk. And that's true, that does reduce the risk. But that doesn't take away from the fact that SoFi generates most of its loans in the personal loan segment. And these have much higher default rates compared to student loans and home loans. So that increases credit risk. Also, in addition to a higher default rate, it has a higher loss when default. So let me explain that a little bit more. With a home loan, not only does it have a lower default rate, but when your borrower does default in those circumstances, you have collateral as a lender that you can go and take so that you can recoup your loss. But when you're lending on a personal loan, there is no collateral. So not only is the default rate higher, but when that customer does default, there isn't anything that you can take from the borrower to make yourself whole. So it's an increasing risk for lenders, and subsequently, if you're investing in SoFi stock, which, closer to 70% of its total loan portfolio is personal loans. And so if macroeconomic slowdown continues and we see increase in job losses, that's when people are at greatest risk of missing their loan payments. And that's when SoFi is at the greatest risk, is during those difficult economic times. And nearly every economic forecaster over these last 4 weeks, including myself, has increased the probability of recession in 2025. because of the increasing risks from the tariffs that are being implemented by the United States, and then the retaliatory tariffs by our counterparties. Higher prices, higher geopolitical tension means slower growth, means businesses hire fewer people, means businesses hold back on expansion plans, and all of that creates more job loss. And that's one of the primary risks for SoFi. But that's a near term risk, and that's not a long term risk. So let's take a look at a long term risk. So, one of the longer term risks for SoFi is that it operates in the financial industry, which has an increasing degree of regulation. Financial regulations. As a financial service provider, SoFi must comply with a complex web of regulations that are always changing. You'll often see banks having to pay fines of hundreds of millions of dollars because it's so difficult to comply with the ever-changing regulation landscape. Sometimes banks don't do this on purpose. They just happen to make a foul with some regulator because of some change that they didn't notice was implemented, because they have so many segments of business and these regulations are changing so frequently. It's hard to monitor and it's hard to keep up with all of that. And that's one of the longer term risks for SoFi, is these regulations become increasingly complex, making it increasingly difficult for SoFi to operate its business profitably because it has to deal with these regulations. It might not be able to offer a product it wants to offer, or it might have to hire so many legal professionals that it works down its profitability, etc. This is a longer term risks. This is a longer term risk that's not going to go away anytime soon for SoFi. And finally, you talk about one of the longer term risks, and that's market competition and valuation concerns. I'm going to talk about market competition first, and then I'll talk about valuation when I look at the SoFi proprietary discounted cash flow model I created. So SoFi operates in a highly competitive fintech landscape, and it faces challenges from both traditional banks and emerging startups in the fintech space. I'm most concerned for SoFi with emerging startups. I'm not so much concerned with SoFi's competition with traditional banks. I think traditional banks are going to find it challenging to adapt to consumer behavior. Their brick and mortar branches are becoming an increasing expense that's not delivering the value that the banks thought it would. They have fallen behind in terms of using that brick and mortar presence as an advantage. Now they could come back and utilize that advantage if they properly train employees and staff these local branches effectively, where when people go into the branch, they get the help they need, they find great customer service, and it makes them want to do more business with that bank. But it's going in the opposite direction. Banks are cutting staff in these local branches, trying to operate with minimal staff and not training staff effectively. And so when I go into one of these branches, I'm rarely satisfied with the service or the capabilities of the individuals that are there to help customers walking in. I then question, why even have these facilities if you're not going to take advantage of being so close to so many customers physically? They could turn that around, but given so many years of underinvestment, I don't think they will. So the bigger risk then for SoFi is emerging startups, which there are plenty, and there are plenty vying for this opportunity that traditional banks have left open, right? It's because traditional banks have failed to capitalize on their advantage that you see these startups like SoFi coming in and taking market share because of that opening that was created by the lack of investment from traditional banks. So when thinking about valuation, it's true that SoFi stock is trading at a more expensive valuation than a traditional bank, but I think it deserves that premium valuation because it doesn't have that brick and mortar presence weighing it down like traditional banks do. right? My proprietary discounted cash flow model has SoFi's intrinsic value at $20 a share. Its current market price is $11.63. So, in my opinion, the stock is undervalued at $11.63. And even if I look at the valuation on a forward price to earnings basis, it's trading at a forward PE of 25, which is near the lowest this stock has traded going back 3 years. So in my opinion, valuation is not a risk. I think the stock is cheap at current valuations, and I don't expect the valuation can or should go down much more from here. Even if there is further volatility, I feel like there is a bottom that's approaching for SoFi stock where it wouldn't go beyond that bottom because the valuation is already so cheap. And then, so to answer the question, at current prices with the current circumstances, is SoFi stock a buy? I think so. I think it is. I have SoFi stock rated as a buy.
Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.